Hello and welcome to Wisdom Bites. Hope you're well. Thank you once again for joining us. Very much appreciated. Now in today's video, I'm going to address people's concerns about what's happening with our main exit indicator, and that is the pi cycle chart here. As we've mentioned many times in the previous 18 months that I've been doing these videos, that the main exit indicator will be when the 111 daily moving average, this is the orange line, crosses above the green line, which is the 350 daily moving average. As you can see, the lines are getting very, very close here. It looks like that within the next 7 to 14 days, the trajectory of these lines appears that we will probably have a cross, unless we have a massive fall here, which will keep the lines apart. So in today's video, I'm going to go through and give you as much information as you possibly can regarding the other exit indicators which are used as a confluence to suggest whether this exit indicator is going to be backed up by other indicators in the charts. That way, everybody can make their own mind up as to what to do when the actual exit indicators cross over, if they indeed do. But before I begin, a very important, polite reminder that I'm not a financial advisor and that all my videos are purely for educational purposes only. And I hope no one out there is going to use my videos as the sole source of information from which they make any investment decisions. Now that would be very alarming for me. So please do your wider research before making any decisions. There are lots of good YouTubers out there who have their own knowledge and their own opinions, just like myself, and you will always make better decisions by gathering as much information as you can. And depending on your strategy, and everybody's got their own unique strategy, so depending on your strategy, you'll have to respond accordingly. So with that out of the way, this video is too important to be distracted by a Snickers bar and a cup of tea. So all eyes on the screen and let's get cracking. So let's start by looking at this pi cycle here. If we look historically, we can see that the trajectory of these lines here are looking like they're going to be crossing very, very soon. I would presume around about between 7 to 14 days. It could happen earlier, depending on the price movements, of course. If we have a jump, then that will actually make the lines cross much quicker. However, we can see the importance of these two lines by looking historically at what happens when they cross. So as you can see quite clearly here, when they crossed over here in the last bull market, that was the top of that market. And if we look left further to the previous bull markets, so this cycle here had two tops. One top here with this cross, and previous to that, this top coincided with this cross here. And if we look further back, it's quite clear that this green line is going to cross over here with this orange line at precisely at around about this crossing there. So what we have, if we zoom out, are 1, 2, 3, 4 data points where the crosses coincided with the tops of that cycle. And currently, we're coming to a cross here. So on the balance of probabilities, that would tell you that this cross that's coming up would mean some sort of a correction here from a top. The price at the moment is not anywhere near a top. So what this suggests is that in the next 7 to 14 days, as we approach a cross, will the price go from here and create a top? And then, as in the previous 4 data points, will we have a crash? albeit a temporary one. So what happened when we came to a cross previously? Let's have a look at that first. So if we look at the last bull market end, when we had the last cross here, this was the beginning of the bear market, which lasted nearly 3 years. And we got a fall within the very few weeks back down to 69–70% initially. Then obviously it went down further down here, all the way down here to 3,100. So this cross was the prelude to a very large bear market. So that's what happened at the end of the last bull market from December 2017. Previous to that, the previous cycle had two tops. Put them together here. So the first top was in April 2013. And as we crossed, we had a top. And that top coincided with a fall of around about the 80% mark. However, we had a very short bear market, and as you can see, we had another cross here, the opposite cross, whereby the 111 daily moving average, the orange line, crossed below the green line, the 350 daily moving average. And that culminated in the cross occurring on the opposite side a few months later in December 2013, which was our real top, coinciding with another cross. And the fall from that market initially was about 65%. But as you can see, there was a bigger fall to come, culminating in this large bear market in the first cycle. And again, on the very first peak that we got, some people would say this was a bull market and then a bear market, but it only just started. Bitcoin only came out in 2009, and this peak occurred very, very shortly afterwards in 2011, a year later. But the significance of this is that the cross, as you can see, if you follow the trajectory of the green line, the cross does coincide with the top here. And again, the immediate fall from there to this line was around about 67%. However, there was a larger fall down to here of about 93%. So really this set the standard of what was to follow in the next few peaks that we got, as we've seen. So the question now is that every time we've had a cross, it has been followed by a substantial correction of 70% plus. So are we going to have a similar correction here? And I've said to you in the last few videos, as this has been approaching, by looking at the Bitcoin investor tool and the pivots, that as the Bitcoin investor tool is coming up to our R2 target line at the end of this month here, the high probability has always been for this month, as I mentioned right at the beginning of this month, that the price for Bitcoin is going to be slowly meandering towards this area here. And that is about 7 days away now, because we're now on the 23rd of March. So we have 8 days to go. And if we get a big surge in the price, this cross could occur quite easily in the next 7 to 10 days. And what I've said in relation to this Bitcoin investor tool is that historically, when you look at this Bitcoin investor tool, it's not an easy line to get past without some major corrections. So we had, in the last bull market, we had 1, 2, you can count these as little minor ones, 3, 4, and this one here, 5. So we had 5 corrections, some of them quite severe, as you can see here. This second one that we had was around 40%, and this one here was around 30%. However, if you look at the pi cycle lines here, during that period of time where we were being rejected at the Bitcoin investor tool line, there was no cross here. But what we know is whenever we have a cross, we have a major fall of 70 plus. So is this what we're going to have here? So this is unprecedented that we're going to have, if the price continues in the upward trajectory, we're going to have a cross at the same time as the price is coming up to the red line here. And everybody has to make up their own mind, depending on their own risk-reward ratio, as well as their strategy in this bull market, to respond accordingly. Now, would I base my decision solely on this one exit indicator? No, I wouldn't. And I'm going to now show you a lot of other indicators that are in play with this exit indicator here. So let's start off with the log growth curve. Currently, we're coming up to this Fibonacci retracement line on this log growth curve. In case you're wondering, the green line is your 50% Fibonacci retracement line. The next one above that is the 61.8 Fibonacci retracement line, and the next one to that one, and this is the critical one at the moment, and that's the 78.6. The reason why this is important, coming up to this line here, which is the second one from the green line, is the second one. If we look historically, in the first cycle, we came up to this line as well. The first peak that we got was in April 2013, when we got rejected at the pi cycle cross. At that time, we came up to, would you believe, at the 78.6. That's 2 lines above the green middle line here of the 50% Fibonacci retracement. So this was exactly where we came to a cross, and that's exactly where we got rejected. Now, the reason why I think that's significant is that currently, if you look closely here, the cross is about to happen, but it would only happen if the price moved very sharply up. And it could easily move to this 78.6 Fibonacci retracement line. The price at that point is currently at 65,850, as you can see here. The Bitcoin investor tool is here in relation to that. So it could quite possibly be that we come up, have a run up to this line anytime soon and get rejected there. And this cross forming anywhere around here. And the question is, as we've seen historically, whenever we have a cross, that leads to a big fall here. And this has been my prediction for the last many videos. As if you've been watching my videos, you'll know that I've been saying that this is what I'm expecting with a high degree of probability. It doesn't have to happen. It could quite easily go straight above this line. But considering what we're seeing in the charts, it looks highly probable that just based on this indicator, we're going to have a correction at this point. So looking at the log growth curve, this would suggest that maybe this time we're following the first cycle of 2013 and maybe getting a cross early and possibly getting a second cross when we come to our target lines up here at the $200,000, $300,000 mark. If you want to support the channel, then please click on any of my videos, and then below the videos you'll find a box called Show More, which gives you a description box, and in that description box is the affiliate link with Etoro that I have. So I partner up with Etoro because that's the main exchange I use for all my investments. These are the reasons why, I tend to use Etoro. It's a very simple exchange to use in terms of depositing money and withdrawing the money, as well as trading if that's what you want to do, as well as for long-term investing, which is what I tend to do. So if you want to support the channel, please click on the partnership link, and then what you'll do is you'll get this box here, and then you can basically put your username, email and password and just fill in the form there. If you like any of my videos and you find value in them, then please don't forget to like and subscribe to the channel. The next indicator to look at would be the RSI. And we said that usually when we come up to the 95 plus, that's when the market tends to top off. We got two peaks here, which culminated in the second peak being the top of the market. We got two peaks here as well in 2013, which corresponded to the two peaks here and there. And as you can see, we've already had one peak over here, but it hasn't actually topped the market yet here. So it may well be, just like the first cycle where we had two peaks, that this could be the peak over here that pushes this RSI up to those levels before being rejected. Of course, these are all possibilities. But one thing I do want to point out, and you may have noticed this, currently here, we have on the weekly chart, which means it's very, very powerful, a bearish divergence. So while we made a lower high here, we made a higher high over here. And this usually plays out very powerfully. So this again indicates that, to me anyway, that should we have the cross on the pie, that itself could bring the price down. However, in confluence with the RSI, which is saying that we've got bearish divergence here. So a quick run up to the 71,000 mark, where the R2 line is on the pivots that I've shown you, and where the Bitcoin investor tool will be in next 7 to 10 days, is going to be around the $71,000 mark. So it may well be that this divergence in the RSI is what's playing out here, that with a quick run up to that price, we could get a rejection. Of course, we don't need to even run up to that point. The divergence itself is powerful enough to give us a big dump down here. So the RSI historically is showing quite clearly that we could come up to another peak over here, and this could be the catalyst for a fall over here. However, currently it's at 68 down here. So it looks like there's quite a lot of growth in this RSI. So it doesn't seem to be a very strong confluence with the pi cycle at the moment. So that's the weekly RSI. If we looked at the daily chart, you can see quite clearly that we'll be making higher highs here and lower highs over here. So again, we've got divergence on the daily chart as well as the weekly chart. So that would suggest that we have some sort of a correction on the way. The next indicator that I want to show you is actually showing the opposite effect, and that is the stochastic RSI. So if you look at the stochastic RSI, we're coming to a bullish cross over here, which would suggest that the market is about to go up. Because if you look left here, when we had the cross there, the market went up. When we had the cross here, the market went up. When we had the cross here, market went up. When we had the cross here, the market went up. So these bullish crosses on the stochastic RSI, as you can see, are clearly very, very powerful. And they usually, as you can see historically here, they usually mean a price up. Now, could it be that this cross is telling us that we're going to have one big flurry up towards the 71,000 and then have a crash? Only time will tell, and everybody has to make up their own mind. I can only show you what's in the chart, and that is that a cross is coming here, and it may be that this is strong enough, an indicator, to push the price to one more high. But what happens after that, only time will tell. So certainly the stochastic RSI is showing very bullish tones in comparison to the RSI, which is showing bearish tones. Okay, so the next indicator I want to show you is the NVT, which is a signal that I've shown you many times before, which works really, really well at the peaks of the market. Now, again, this is showing quite bullish tones because, as you can see, since the rally started here, we haven't had a change of color. We've had a continuous red all the way through up till now, and we still haven't changed here. It's still red. Now, if you look at the other peaks that we've had in the past, look at this. When we had the last peak in 2017, we got a change in color from white to red. The two peaks that we had in the first cycle, look closely here. We got, at these peaks, we got from white to red, change in color. In this peak here, from white to red, change in color. So that would suggest to me that maybe this is not a peak that's coming up here. So at this cross, will we change color here? Only time will tell, but the current facts of the matter is that there's been no change in color. It's looking bullish. And again, please remember, this is a weekly indicator. So this is now going to not change until next Sunday. So in the meanwhile, if the price fell, this could change the indicator on Sunday, or if we had a big push up towards the end of this week, and then over the weekend, let's say, we had a massive fall, this would change the indicator. It could easily reset to a white line. So only time will tell, but this indicator currently is saying that there's no imminent fall on the way. I'm also going to have a look at the 21 weekly exponential moving average. This is the yellow line here. And I mentioned in my last video that we haven't come back to test this level since the 28th of September, the week of the 28th of September. If we did have a correction, and if we drew our trend lines here, so this is the top of the trend line, this white line was the blue line I drew in the last video, saying that the bottom of that was around the 54, 53 mark, and we've now gone down to the 53 mark today. And this is a trend line that's been stretching all the way back to December here. So it's quite a strong trend line. But obviously, we can easily break that and go to the next line of defense, which is this blue line here. That stretches back to October last year. And the interesting thing here is that the 21 weekly exponential moving average is very much in line with that support currently over here. But if it's going over here, then any correction up to these levels here, 70,000 mark, could bring that down to meet the 21 weekly exponential moving average around this blue support line here, if that was to happen. So this would be a natural place. And the reason why I say that is if we look historically, in the last bull market, when we had a correction, we came back to the 21 weekly exponential moving average. And in the two peaks that we had, you can see quite clearly that when we had the rejection at this point, when the pi cycle crossed, and here, when the second cross occurred in this cycle, the market came back down to the 21 weekly, and same here, the 21 weekly. So that seems to be the natural place for the price correction to take place if it takes place. Now, the other question people ask is that, is this the top of the actual market? Well, there is one other indicator which would suggest that we're not really at the top of the proper bull market, and that if we do have a peak, it will be temporary, because there is one indicator which I've shown you many months ago in the past, which is based on this yellow line here, which is the 1458 daily moving average. Now, I've not seen any other YouTuber use this line, maybe because we don't have a lot of data points for this. But let me show you something very interesting here. Let me start off by drawing a horizontal line at the peak of the first bull market here in December 2013. If you take the line across, where it meets the 1458 daily moving average, that is also the peak of the last bull market. So the top of the first cycle, in combination with the 1458 daily moving average, predicted the top of the second bull market. So if we continued that and drew a horizontal line at the peak of the last bull market here, look where we are with the 1458 daily moving average. We're nowhere near the cross of that horizontal line with the 1458 daily moving average. So again, this would suggest that we are nowhere near the top of the bull market at this point in time. However, again, it plays to the narrative that maybe this time we're going to have two peaks, here and here, by which time this could take the trajectory anywhere around here to meet up with a blow off top at the end of this bull market. Only time will tell, but I thought that would be very interesting, and it shows quite clearly that we're not, according to this indicator, that we're not at the top of the blow off top in this bull market. So coming back to the original question of the pi cycle crossing in the next 7 to 14 days, I've shown you with all the indicators of where the market could possibly be. And the truth of the matter is, I don't have a crystal ball. Ultimately, everybody has to make up their mind of how they will respond if indeed we do get a cross of these two lines here. Certainly, it's very fascinating. Many people may choose to reduce their holdings when the cross occurs with a view to buying back, or many people I know are going to actually just hold through until we get to the proper end of the bull market. Whatever you decide, the best thing to do is to do your wider research, find out from what other people are saying, and then make up your own mind of how you will respond to this cross, if indeed it does occur in the next 7 to 14 days. Okay, so we'll wrap it up there. Thank you once again for watching. We haven't got time for a wisdom bite today. I'll try and cover that in the next video. If you found value in this video, then please do remember to like and subscribe and to turn on the notification bell. And if you have any comments, questions or suggestions, then please leave them in the comments below. Until the next time, take care, stay safe. Bye for now.